Almost everybody knows somebody who supposedly figured out the stock market. An uncle who bought an Nvidia at $50, or a coworker who got into Tesla before everybody else, or a friend of a roommate of a friend who claims that he doubled his money in 3 months. But what we hear less about are all other stocks they bought, the ones that went nowhere, collapsed, or were quietly removed from the story. And it leads to one of the strangest facts in investing. Even professional investors, with research teams, expensive data, and entire careers devoted to selecting stocks, often fail to beat the overall market consistently over long periods. So what happens if you stop trying to find the winner? What happens if instead you simply own the market? That is the idea behind the index fund. To understand an index fund, we first need to understand what is an index. An index is simply a collection of investments selected according to a specific set of rules. For example, S&P 500 follows approximately 500 large American companies. The NASDAQ 100 tracks 100 large non-financial companies listed on the NASDAQ exchange. A total market index may contain thousands of companies. There are also indices for international stocks, small companies, bonds, industries, specific sectors, even commodities. The index itself is not something you buy. It is simply a list together with rules that determine what belongs on that list. Think of it as a model of the market. An index fund is an investment fund built to follow one of those indices. If the fund, let's say, tracks S&P 500, it buys shares in the companies included in the S&P 500. It tries to hold them in approximately the same proportions as the index. When the index changes, the fund also changes and adjusts its holdings. The fund manager is not constantly trying to decide which company is about to outperform. The goal is much simpler: to simply replicate the performance of an index as closely and as cheaply as possible. The approach is often called passive investing. You are not trying to beat the market, you are trying to capture the market's return. Let's take a look at a simple example. Imagine a tiny stock market containing only 5 companies. Company A represents 40% of the market, Company B represents 25%, Company C represents 15%. Companies D and E represent 10% each. An index fund following this market would divide its money in those same proportions. So if you invest $1,000, $400 goes into Company A, $250 goes into Company B, $150 goes into Company C, and $100 goes into each of the remaining companies. With one investment, you now own part of every company in this small market. The first major benefit is diversification. Instead of placing your money into one company, you spread it across many companies. If you own the stock and that company fails, the damage can be severe. But if the same company represents only a small percentage of a broad index fund, the effect is limited. Other companies may continue growing and producing profits. Diversification does not eliminate risk. A broad index fund can still fall sharply when the market falls, but it reduces your dependence on the success of one company, one product, or one management team. You are no longer asking one business to carry out the entire investment. It's very important. And the second major benefit is that you already own the companies that eventually become the winners. So imagine looking at the stock market 20 years ago. You would have needed to identify in advance which companies would dominate smartphones, cloud computing, digital investing, online commerce, or artificial intelligence. Well, that sounds easy, only after it has happened. An investor holding broad index fund did not need to predict every single winner in every single story. As successful companies grew, they became more valuable and more important within the index. And the investor benefited simply by continuing to own the fund that tracks that index. You are not betting that every company will succeed. You are betting that the overall market will continue to produce successful winners. Many major indices are weighted by market capitalization. Market capitalization basically is the value of the company, and they are weighted within that index. It's the total market value of the company's outstanding shares. That's the total market capitalization. A company worth $3 trillion obviously receives a larger position within it than a company, let's say, that worth only 1 billion. This means an index fund does not necessarily divide your money equally among every company. The largest companies can represent a significant share of that fund. As a company grows, its weight may increase. As it declines, its weight may shrink, or it completely may be removed from the index. Like, for example, we had Sears removed a few years ago. This allows the index to change naturally as leadership in the market changes. But it also means that even a fund containing hundreds of companies can still be heavily influenced by its largest holdings. So why index funds are often cheap? Well, cheap is not the right word. Index funds are also known for relatively low fees. An actively managed fund may employ analysts and portfolio managers who research companies, meet with executives, build forecasts, and constantly decide what to buy and to sell. An index fund just has a narrower job. Just follow the index. That usually requires way less research and way less trading. The annual management fee is expressed through so-called expense ratio. An expense ratio of 0.5% means that the fund charges approximately $5 per year for every $10,000 invested. That's incredibly reasonable. A small difference in fees may not look important in 1 year, but over several decades, it compounds. It compounds into a meaningful amount of money. Every dollar paid in fees is a dollar that is no longer reinvested for you. An index fund is not one specific investment. It is a type of investing strategy. One index fund may track S&P 500, another one can track the entire US stock market, another may hold international companies, another may track government or corporate bonds. There are also index funds focused on small companies, industries, commodities, and narrow market themes. These funds all can have very different levels of risk. That is very important. A broad total market fund and the fund tracking one small industry may both be index funds, but they do not provide the same diversification, stability, or exposure. The most important question is not simply whether the fund follows an index. It is which index the fund follows. Index funds are commonly offered in two forms. The first is a traditional mutual fund. The second is an exchange-traded fund, or ETF. Both may follow exactly the same index and own almost identical investments, and the difference is mainly in how they are bought and sold. An ETF trades on an exchange throughout the day just like a stock. A traditional mutual fund generally is bought or sold at a price calculated after the market closes. So an ETF and an index fund are not the opposites. An ETF can be an index fund, and an index fund can also be structured as a mutual fund. Let me say this again. The ETF and index funds are not the opposites. ETF can be an index fund, and an index fund can also be structured as a mutual fund. The index describes the investment strategy. The ETF describes the trading structure. Index funds are simple, but they're not risk-free. If the stock market falls, the broad stock market will also fall with it, and the index with it. Index funds are simple, but they are not risk-free. If the stock market falls, a broad stock index fund will fall with it. During a major market decline, the value of the fund may drop significantly. An index fund does not move your money into cash when conditions are frightening. That's also important to remember. It just continues to tracking the index. There is also concentration risk. A technology index may be highly dependent on technology stocks, obviously. An index focused on one country depends heavily on that country's economy. A bond index can lose value when interest rates rise or when borrowers experience financial trouble. The risk always comes from what the fund owns. Before buying an index fund, examine a few basic things. First, which index does it follow? Second, what investments are actually inside of it? Is it spread across thousands of companies or concentrated in one narrow sector? Look at the expense ratio. Look at the largest holdings. Check whether the fund has followed the index closely. And consider whether the level of risk fits your time horizon. A stock index fund may be appropriate for money invested for many years. It may be completely inappropriate for money you need 6 months from now. The fund should fit the purpose of the money. Some of the most common index funds categories are very straightforward. An S&P 500 fund tracks large American companies. A total market fund includes large, medium-sized, and small American companies. An international index fund invests in companies outside of the United States. A bond index fund may hold government bonds, corporate bonds, or both. And none of these is automatically the best choice for every investor. They serve different purposes. Stock funds are generally used for long-term growth. Bond funds provide stock funds generally used for long-term growth, while bond funds can provide income and reduce volatility, and also potentially carry less risks. Many portfolios use combination rather than relying entirely on one strategy. So the basic idea behind the index fund is simple. An index is a list of investments selected according to the rules. An index fund buys the investments on that list. It allows you to own many companies or bonds through that single investment. It reduces the need to identify individual winners, and because the strategy is relatively simple to operate, the costs are often very low. An index fund will not protect you from every market decline. It will not outperform the market it follows, and it will not make investing emotionally easy. What it offers is something more realistic, a low-cost way to participate in the long-term performance of an entire market. And for many investors, that is not a compromise. It is the strategy. If you like my content, please click like and subscribe.